Hello everyone. In today's video, I'm going to be speaking about these 7 very popular stocks that have gone up in value quite a bit over the past few years, and they've made many people millionaires recently. So if you're interested in learning about these stocks, definitely stay tuned. And if you do enjoy content like this, please consider liking the video and subscribing. It will be greatly appreciated. So these stocks are not only popular because of their significant growth over the past few years and more recently so, but they're also extremely popular because of the fact that they've been propping up the market basically by themselves. We have an article here on the NASDAQ that states, given that these 7 mega caps account for a massive sway over the S&P 500, an argument can be made as to whether the rally is really broad, as it's believed to be. So in other words, the market is increasing, but the basic counterpoint is that it's not the entire market, it could be something else. So as of Friday's close, the S&P 500 is nearly up 15% year to date. But without the market cap weighting of these 7 stocks, also known as the Magnificent 7, the S&P 500 would be in negative territory for the year. So simply put, without these 7 stocks, the market as a whole would be negative, and this speaks to how heavily concentrated the stock market basically is in these companies. And I have spoken about this before in several of my videos, how a lot of value is at the top. It's very concentrated in a few different companies, and the companies that aren't these 7 stocks haven't grown quite as much. So within M1 Finance, I made a portfolio to track these 7 stocks to basically show how they increased in value over the past 5 years, and even more recently, year to date, they are up 110%. Now, I weighted these equally in this portfolio, or about as equally as I can get with 7 holdings out of 100. And basically you see that, yeah, these stocks are up quite a bit, and they've made people millionaires, each and every single one of them, especially some of the ones that I am going to get into in a little bit. What are these 7 stocks? So the 7 stocks are Google, Amazon, Apple, Meta, formerly known as Facebook, Microsoft, Nvidia, and Tesla. Now, Nvidia and Tesla have gone up an extreme amount recently, and they have both made people millionaires in a very quick fashion. Now, in contrast to the way I invest, these are, of course, not dividend stocks. Very few of them pay dividends, and the ones that do pay dividends pay a very low dividend. They are more focused on growing their dividend or capital appreciation as a whole. Now, these 7 stocks, you may have noticed, are basically all in the same industry, although Tesla can be argued that some people would say it's an automotive company, but with their battery engineering and their AI, it's really a technology company, and all of these companies are technology companies. And we see that the technology sector as a whole has gone up quite a bit year to date, about 50%, and this is just the Technology Select Sector Spider Fund. It basically invests in technology companies and a pretty wide, diverse slice of them, but it is not investing in other industries, of course. So this is in contrast to other sectors. So this is how the utility sector has performed year to date. It is down 11%. This is how the real estate sector has performed, down about 4%. This is how industrials have performed. It is up quite a bit, 11%. But if we look at the S&P 500 year to date, it is up 19%. So even that industry is trailing the S&P 500. This is how the energy sector has performed year to date. It is basically stagnant. It has barely gone up, but at least it's gone up, but still quite a bit underperformed the stock market as a whole, the S&P 500. So basically, this is kind of just a rough overview to compare this to different industries and show you how much the technology sector has outperformed every other sector this year, and may continue to outperform depending on whether rates stay the same, increase, or decrease. We will see in the future. Now, going back, we see that even the technology sector has lagged these 7 stocks by a significant amount. We're talking about 70% gain difference, basically. So I think it goes to show that these stocks definitely play a significant part in the performance of the stock market. They're all large cap. They're all valued in the hundreds of billions or in the trillions at least. And now investors continue to flock to these stocks because of their popularity and their growth. But I do believe that that is a bit dangerous, and I will show you why. Now, a key danger to this reasoning of just putting all of your money into these companies is its lack of industry diversification. These are all technology companies, as I stated previously, and they are very dependent on the technology sector, whether it be a regulation that can come up or interest rate changes. These are stocks that are very dependent on whether or not the technology sector can continue to outperform in the long term. Now, out of these stocks, there's basically 2 of them that I believe are really overvalued, and that is Tesla and Nvidia. Now, Nvidia has come down in value, relatively speaking, compared to what it was previously. The price did drop a little bit. So if we look at the PE of Nvidia, we see that the PE of Nvidia is trading at 40 times forward earnings. And the PE of Tesla is probably one of the more overvalued of all of them. It is trading at 73 times forward earnings. Now, fortunately, there are some other stocks in there that are not really overvalued. I do think that Google is kind of fairly valued. It's only trading at about 24 times forward earnings and is an extremely solid company. They have a diverse business model and everybody uses their services. This video is hosted on their platform. They own YouTube. Apple is a bit slightly overvalued. However, I guess not maybe for a tech company. It is trading at 29 times forward earnings, which is probably a little bit overvalued. It is more overvalued, it looks like, than Google. Quite a bit less undervalued than the other 2, Nvidia and Tesla. So I don't think that Apple is really a bad pick currently. Just keep in mind it did increase in price recently. The time to buy it would have been when it was trading down. And Microsoft also boomed recently, and its PE is 33 times. And again, for a tech company, I guess it's not too overvalued. And again, it's not as overvalued as Tesla or Nvidia, but it is still on the higher side. Again, really well performing company. It is almost valued at $3 trillion, the market cap. Just incredible overall what this company has done over the past few years, and over the past 1 year, 5 years, it's up 266%. Over the past year to date, it's up 57%. And over the past year, it's up 54%. So great performance. And the last 2 stocks in that list, we have Amazon, which has a pretty high PE at 55. It's now even higher than Nvidia. We do see the recent boom, and I think that this company, it kind of deserved the boom because of how beat up it was for a while. We see that it just dropped and dropped and dropped and dropped and dropped. And the funny thing is that this is probably because of interest rates. Once we got the signal that interest rates were increasing, this stock just dropped like a rock, and it was basically, people like valued it at it was going bankrupt. Basically, this $1 trillion+ market cap company just dropped a massive amount overnight. It seems, of course, not literally overnight, over a few months. And again, part of that was probably because of interest rates and the decrease of consumer sentiment. Inflation was high, and of course, when inflation's high, consumer discretionary stocks like Amazon, which does sell products through its store, definitely dropped. It's an e-commerce company mainly. It does provide different technology services, but its main product line is e-commerce. And when the economy drops, people aren't buying. When inflation's high, people spend less on discretionary items, and they put their money into things that they actually need to live. And this is another stock that has performed very well. This is Meta, which is formerly Facebook. It's almost about time to stop calling it Facebook and call it again by its current name, which is Meta Platforms. And this is probably one of the more fairly valued stocks at 23 times forward earnings, or 24. And this stock has truly boomed over the past year, up 206%, and year to date up 173%. Now, this stock was down for different reasons. I think the sentiment around this company got really bad. There was a lot of investigations into it. People were against Facebook and all of its other services. They do own Instagram and other software entities and apps, but this stock was beat up significantly, and it got down to under $100 a share. And it's interesting because, of course, I didn't buy the stock, but I was speaking to one of my family members about how undervalued this company seemed at that point, and that was around October or so of this time. And I said, this company's really undervalued rather, and it doesn't deserve to be this undervalued. And sure enough, I didn't buy, and it just boomed. Now, the forward concern about this is these stocks are technology companies, and this has happened in the past. Of course, the dot-com bubble in the late 1990s, when technology stocks have basically just eroded in value. Now, the fundamentals that led to this are a bit different than the fundamentals of these companies today, and we really don't know if their growth will continue or if they will drop. Now, the difference between the companies in the dot-com bubble and the companies today is that a lot of companies in the dot-com bubble were not valued properly because they pretty much had no earnings whatsoever. They were basically just seen as like a new paradigm or something, that everything was going to revolve around tech, and companies that had no right to even be valued as high as they were valued were valued quite high. And we see what happened when that bubble burst. It shot up. It was showing exponential growth, which doesn't really occur in a market. And then the bubble popped, and then it was a massive drop, and it took many, many years to correct itself back to where it is or where it was. Now, the good thing about these companies is that the article goes on to say that these companies have tons of cash on their balance sheet, strong cash flows, and excellent leadership. So these companies, even though they are trading a bit high, they are fundamentally secure. They do have good cash flows, very high user base, and they basically have the fundamentals to kind of support their valuations. So I made a chart of the S&P 500, how it's broken down, at least the top 10 holdings, and the top 10 holdings account for about 30% or so of the total S&P 500. And we can see that the Magnificent Seven are in the top 10 holdings of the S&P 500. We have Apple, Amazon, Microsoft, Nvidia, Google, Tesla, and Meta, and of course the bottom two, Berkshire Hathaway and ExxonMobil. Now, for people that don't want to have this exposure, I kind of do something a little bit differently. Of course, even though I'm not directly invested in all of these companies, I do hold some of them comparable. Like, I do hold in my top ones Microsoft, Apple, and Amazon within my top 10. Now, I do hold everything else too. I basically use my portfolio, and it's 4 different ETFs. I did a video on this a couple weeks ago. If you'd like, check out the breakdown of that video. Now, my portfolio is quite a bit more diversified than the S&P 500. It's not as concentrated, so the top holdings will not be as affected by the performance of these high-flying tech companies, and it is quite a bit diversified overall. I do have in the top 3 technology companies, we have, of course, 2 of the Magnificent Seven, Microsoft and Apple. Then I have Broadcom, United Healthcare, ExxonMobil, JP Morgan, Visa, another Magnificent Seven, Amazon, MasterCard, and Johnson & Johnson. So I am invested in these companies, but I am just concerned that they might be overvalued and their performance may eventually come to an end. And my investment style is a bit different. So I basically have two separate accounts. One is kind of a growth and the other is a dividend. So go here and I will quickly show you an overview. So first I have the growth fund and it is currently sitting about at 48,000, and the two ETFs that I hold are the Vanguard Dividend Appreciation ETF and the NASDAQ QQQ, which tracks all those technology companies. And my other portfolio is kind of a dividend portfolio, and the intent is to just pay me income that I don't have to pick individually, and it's simply SCHD, a very popular dividend ETF, and JEPI, which is another popular dividend ETF. So thank you all for watching today, and remember, if you did enjoy this content, please like and subscribe for future videos. Have a great day.